Well, with the world seemingly going to hell in a handcart once again, I thought it'd be an opportune time to have a look at what is happening from a broader perspective in the markets that I cover and have an interest in. But before we begin, as usual, a little bit of parish news. Because I'm looking at live markets, these are not the usual historical examples that I generate, I have to give this fairly generalised warning. We have an AFSL, an Australian Financial Services Licence, that enables me to look at these live markets. But nonetheless, everything I speak of is simply general advice only. In no way can any of it be implied to be personal advice. Unfortunately, ASIC believes that nobody in the world is a grown-up, so I have to tell you these things. Also, before you go, don't forget to like and subscribe. The liking is good for my ego. The subscribing makes the SEO people feel like they're actually earning their money. So in terms of a broad look at the markets, I want to start here with the Dow. I don't normally look at the Dow simply because it's such a narrow, idiosyncratic index. But this offers a very interesting picture that you don't often see in an index. And that is, you can see, end of March, beginning of April, double top, there's then a gap. And it's quite a strong gap. There's an attempt to fill that gap, but that ends down for the day, and we then have this succession of down days. Friday was an up day mildly. But the thing to have your attention drawn to is this notion of the gap. Gaps are very, very powerful indicators of a shift in sentiment. So it is something to be aware of. Now, this is where I want to spend a little bit of time. And I want to do it because to me it looks like there is a pivot shift going on. This is the NASDAQ 100. You can see that it has struggled over the past, let's say, 3 weeks or so. And this week was somewhat disastrous for it. And there is a reason for that. And the reason is this seeming pivot shift that is going on. And the shift I talk about is this. For the past year, gains in the NASDAQ 100 and to a large degree gains in the S&P 500 have been driven by 7 companies. Nvidia, Meta, Tesla, Amazon, Alphabet or Google, Microsoft, Apple. They've done the heavy lifting for the market for the past year. This means that the gains have been very, very concentrated. It means that the rest of the market has not really contributed. This generates a fragility in markets because the moment these stop contributing, price begins to fall back. And we can see this contribution here, which looks at the accumulated return last year of these magnificent 7, the S&P 500, and the remaining 493 S&P 500 companies. I'll actually come back to this chart a little bit later on. So as you can see, the drive is coming from a handful of stocks. Again, a dangerous thing. In looking at this shift, what I've done here is broken them down into their 1-day change, so they change on Friday, 1-month change, 3-month change, just to get a broad sense of what is happening over time. And you can see Friday, very ordinary day, particularly for Meta and very particularly for Nvidia, which had been a driver. It's been the standout stock of this bunch for the past year. And it is still up 28% for the last 3 months, so that's fairly positive. Same with Meta. So they're still largely holding their 3-month gain. The one that is not is Tesla. But the issue here is not what has happened over a day or a month or 3 months with Tesla. It's what's been happening over the year. And I'll actually have a quick look at Tesla in a moment. So you can see there is this change and this uncertainty. It will be interesting to see in a few weeks' time whether that 3-month change for all those that remain positive has actually been wiped out by this little correction that is going on. So if I put these in a tableau and have a look at them, you get an instant sense of what is occurring. And you can see, these are weekly charts, by the way. Remember, all context comes from weekly charts. Despite what you see on the internet, it does not come from looking at 1 and 5 minute charts. What we're trying to do here is define what the signal is amongst the noise. And the easiest way to do this is to apply more data. So you in effect get a data smoothing effect. So you can see for all of them last week, it was a very, very ordinary week. And you can see with Nvidia that somewhat precipitous 10% drop. Now I mentioned Tesla. Tesla's been rubbish for over a year. And it has given up its highs and continues to be ensconced in this longer term downtrend. It is really no longer the darling of the market, and by all intents and purposes probably should not be included in this group, simply because if you look at this group, you look at the first 6, you can see that 2023 was an exceptional year for all of them, particularly Nvidia and particularly Meta. They did exceptionally well. All you got with Tesla was a long grind downwards. But in terms of what I find interesting in these particular stocks, there's 2 I find interesting. First is Apple. It is sitting in this congestion zone. It's come back from 200, now sitting at 165. Congestion is very important to me because it indicates uncertainty. It indicates that the market does not know which way to go, and eventually it will decide. And when they do decide, they move very, very sharply. If I was still silly enough to be holding this stock, I'd be very nervous about this 165 level. By the same token, depending on your approach, and it's not really one I advocate, there is sufficient room between 165 and 200 for those who are quite nimble. But again, it's not really a practice that I advocate, simply because my experience and observation has been all that happens with people who do this is they chew their account up. Yes, they get the entertainment value of trading, which is largely what most people are after, but they don't make any money. Surprisingly, Microsoft shows a similar pattern, but with a much larger drop from last week. So again, we have a heavyweight drifting between 2 price points. Here the range is a little bit narrower. We're looking at around 432 mark to just under 400. So it's a 10% range. It's not that much room for anyone who is not the most nimble of traders. But I said I would come back to this little graph simply because it is so instructive of where the drive in the market has come from. That in turn gives us an indication of what we might expect as one of our possible scenarios for the market going forward. Notice I didn't say prediction. Prediction is impossible. Anyone who says they can predict the market has gone off their medication. And here, the thing to concentrate on here is the return from the other 493 S&P 500 companies. They've really not done any of the heavy lifting. And so if we look at the S&P 500 weekly, we can see last week, we see that moving into this year, the market's been very positive and has been very, very strong. It's quite naturally been a buyer's market, again driven by the last gasp of the Magnificent Seven. And you can see the correlation between them giving up their price gains and the broader market falling back. And if we look at this daily, we see something interesting, somewhat analogous to the Dow, but because there are more stocks involved, it is less clear-cut from this perspective. We see that top, see the gap. The gap is then filled more strongly than it was with the Dow. And the past week has been disastrous for the S&P 500. This to me is not a buyer's market at present. I'm not one for shorting indices. I've actually found that when I've included it in my repertoire, my performance drops off. I simply don't get enough grunt for the way I trade to make it worthwhile. But it is still indicative of a weak market. So it is not a market I would be looking to buy. My macro for the S&P 500 has switched itself off. And once it switches itself off, there is nothing to do other than stand back. What is interesting, though, is I have a broad metric. And the broad metric is the percentage of stocks above their 200 period moving average. This is a weekly chart. Again, context is given by looking at weekly charts. And you can see that there were a percentage above their longer-term moving average, which was around about 83-84%. Market drifted off so that around when this last candle appeared, it hit a low of 65%. And so you can see that the market at large has drifted back, where a growing proportion of stocks are below their 200 period moving average. In terms of what this means for us locally, my opinion of the local market really hasn't changed all that much. In the absence of a full-blown boom in mining stocks, there's really no reason to be interested in the local market. You can see we broke from our longer-term congestion, but couldn't hold it and fell back. That inability to hold these new highs is, for me, a concerning sign. When you have markets break out of congestion, you want them to continue to make higher highs. That's indicative of strength and interest in the market. Here we don't have that. And if we look at this on a daily perspective, you can see that the last week, bar Thursday, were very ordinary days. Yes, there is that rejection on Friday where the market came off its lows and where the market is sitting about near enough to where it finished low in February. So we have these two spike lows. Again, it's not really a buyer's market. And once again, in the absence of something happening with mining stocks or some sector within the market, it remains a speculator's market and not an investor's market. And this is a point I think that catches people offside. The Australian market represents, on any given day, around about 2% of world market capitalisation. So it's very small. It lacks the diversity of industry that, say, the US markets have. Therefore, it lacks the diversity of opportunity. The other point to note, and this is simply one of historical context, the majority of stocks that are listed on the Australian stock market disappear. They come and they go, they come and they go. So it remains a speculator's market. My interest of late has been in commodities. And here I've done something similar to what I did with the Magnificent Seven. I've looked at their change over respective time periods. So these are little slices in time. And you can see that the standout performer is cocoa. And I'll have a few things to say about that in a moment. What is interesting here is that the poor performance of gold. And I will have something to say about that in a second when I look at instruments that were supposed to be a hedge against uncertainty, which were supposed to benefit from uncertainty. But the thing to note from here is, how do we actually look for commodities such as cocoa and coffee? And there are a few tricks that I think are necessary for people to be aware of. This is taken from FinViz. FinViz is a free site. It generates this performance metric. This could effectively be called a smile, and you'll note that I've highlighted the upper and lower boundary of this particular smile. This one looks a little bit distorted simply because of the performance of cocoa, which has been outstanding. As I said before, careers are being made on cocoa, and they're being made while people on social media bang on about gold going up 10%. They've missed the boat and they've missed the point. I've highlighted these two boundaries for the simple reason that this is where you want to be. You want to be in those instruments that are displaying a high rate of change in price. The problem is that most traders spend their time dicking about in the middle of this smile for whatever reason, whether it be that they're driven by some form of fundamental, some form of sentiment in terms of trying to find those instruments that they consider to be on the verge of something happening. I'm not really interested in something being on the verge of something happening. I might be on the verge of winning the lottery merely because I've entered. Doesn't mean I'm going to win, but I'm still on the verge of winning. What we are looking for are instruments where we have this high rate of change and this continuous sort of, let's call it a production line of new highs, new lows being generated. And case in point, let's talk about cocoa. And I understand the psychological difficulty that trading something like this generates for people. The first two breakouts are fairly easy to take without generating that much angst. Second, third one, not so bad. Fourth one, we're now starting to get a little bit uncomfortable because price has effectively doubled from the first breakout. Final breakout, definitely uncomfortable. But my point would be is that if you are comfortable with your trading, you're actually doing it incorrectly because for some reason you think you've removed the uncertainty. But it is within the uncertainty that our profitability lives. If uncertainty is removed, then risk is removed. Once risk is removed, reward is removed. And as we can see from this final breakout, which was actually a break of congestion, price has gone up some 90%. So even at that stage, this is a viable move. It's a viable trend. And we can see this put in context when we step back and look at the weekly chart. You can see how powerful each breakout was from the previous one. What has been most interesting to me for this week has been the movement in the energy complex. We have two major powers in the Middle East saber rattling and going toe to toe with one another. And what did crude do? Well, it actually went down for the week. Same with heating oil, same with gasoline. Not what we would have expected from an historical perspective. And if we look at crude daily, we can see that the peak was actually the prior week. And so we've had this break of congestion from February, March, a gentle drift up. It was by no means spectacular. We then have a drop on Wednesday, Thursday. Friday was a chaotic day where prices spiked all around the place without actually really doing anything other than bumping out traders who were both long and short. My expectation is that would have or should have been a dynamic up day. And this brings me to the point that historically we've had what we perceive to be a raft of commodities or instruments that benefited from some form of international turmoil or conflict. Crude is one of them, but not in this instance. And in fact, historically, if we look back this century, crude is not responding in the way that it would have in the past. And I think what lingers in people's minds are the oil shocks of the 70s. And so that's stuck, and that has become the default belief system. But I don't think that belief system actually holds up in the face of the evidence we have. What is intriguing too is that we've had this breakout in gold. And I will freely admit I take the piss out of gold bugs all the time because they're so remarkably childish. But we had the breakout, we had the gap up in March. We've not had gold move to a new high. And I would have thought that would have been a default setting. Again, this seems to be one of those myths that has crept into the market, that gold responds to international tension as people flee to a safe haven. I don't think they do. And the evidence does not seem to indicate that. And in trading, as in all things in life, you can only go on what the evidence says. You can't go on what you feel. No, let me rephrase that. You can go on what you feel, and that's how most people go. Majority of traders don't make any money. But what is interesting is that both crude and gold could be regarded as, let's call them legacy commodities or legacy instruments, because they're drawn from a different time, and they're both very old commodities. And they're very old commodities that, as I said, people used to flock to, or there was the perception they flocked to, in times of uncertainty. This brings us into a new age, a more modern age, where this might not be a thing. And so we have digital currencies like crypto, which is marketed as a hedge against inflation. It's not. Store of wealth. It's not. Or maybe it's good in times of uncertainty. No, it doesn't appear to be either. And to be honest, I'm not certain how to interpret how the market is interpreting these latest shenanigans in the Middle East. It may be that the market is simply sick of it, ignored it, and is moving on in its own particular way. I don't know. But there is an instrument that the market does seem to have taken to in this particular time. And it is the US dollar yen. And you can understand why. US dollar, strongest in the world, strongest economy in the world. It is easy to transact vast sums of money in FX markets. It is not easy to transact vast sums of money in Bitcoin. Irrespective of what you're told, it's almost impossible. You could not, for example, drop $1 billion into Bitcoin, nor could you withdraw $1 billion from Bitcoin. But you can with currencies, and this is the US dollar yen weekly. And as we can see, it's taken out that high from September 22. But if we even step back a little bit further, we can see that it's taken out the 1998 high and is on track to take out the 1990 high. So it's on track to make a 34/35-year high. I find this very, very interesting, that all of a sudden there is a flight to this as an instrument of refuge. This brings me to what I'm looking at for the coming week for my particular trading portfolio. The first is soybeans, which is sitting on support at present. I already have an existing position within the complex, but I am waiting and watching. Same is true for soybean meal, which is range trading at present and is nudging towards the upper limit of its boundary. Again, we come back to this notion that congestion is a very powerful tool. The other one is natural gas, and it is part of the energy complex, but it has been battered for an entire year and has been one of the more spectacular commodity shorts of probably the past decade. And we can see last week, gap up, indecision as it bangs against this upper boundary. And it is that indecision that fascinates me. If that switches from indecision to decision above the boundary, then to me, that is a buy. That is the market telling me something. It is telling me that the conditions that prompted price to be moving sideways have now changed. So we've moved from uncertainty, where nobody is certain who is in charge, to certainty, where there is now a predominant group in charge. And the final one is not one I would normally talk about because they don't normally interest me or pop up on my radar. But I do have a scan over the local market that simply looks at, let's call them abnormal increases in volume. And this is the Beta Shares US Strong Bear ETF. It's an inverse ETF. So as price goes down of the underlying, it goes up. As I say, not really a fan, but you can't ignore when you get a volume spike like this. So obviously for some reason, some people have taken this as being, I don't want to say hedge, that's the wrong word, but they've taken to it as perhaps a potential short-term trade should the market fall away. There are problems with inverse ETFs in terms of the way they calculate their percentage change based upon the underlying. And it makes it very difficult for them to go up in anything other than a catastrophic event. So in terms of what I'm looking for next week as a roundup, nothing in US stocks, nothing in local stocks. I will park that statement for a second and say that there will always be some opportunity somewhere in the local market, but some opportunity somewhere doesn't really interest me nor fit into the way I see the world. To me, that does not guarantee me a long-term edge. It's more akin to simply having a punt. And the last words you want to creep into your trading plan are, I will have a crack at. Because that, to me, implies that you're just having, as I said, a punt. It's a gamble. I am looking to the commodities I spoke of, and I am interested in this bear ETF, if nothing other than from an academic perspective. But it will be interesting to see if the shenanigans in the Middle East produce any more changes in markets. It does seem that markets are a little bit more mature in the way they view these things. So barring some catastrophic coming to blows, I'm not certain the market will respond that strongly. I'm also interested to see, and this is the big point for me, and it will be something I watch from day to day, is whether the pullback in the Magnificent Seven continues and the impact that has on the market. Because if that is a true pivot shift, then you are getting this transition in the US market from being strongly bullish through neutral to bearish in some way, shape or form. And I've no idea what form that will take or how long it will last. But it will be interesting.